In October 2024, OpenAI closed a funding round that valued the company at $157 billion. This is a company that reportedly generates around $3.7 billion in annual revenue, but loses money on nearly every interaction. Its primary product, ChatGPT, costs more to run than it charges users. The company burns through billions in compute costs annually. It has no proven path to profitability at its current scale, and yet $157 billion. For context, that's more than the market capitalization of companies like Goldman Sachs, FedEx, or American Express. Companies with decades of proven profitability, massive infrastructure, and millions of customers. This valuation isn't an anomaly. It's the norm in AI in 2026. The entire sector operates on a financial logic that seems to defy traditional metrics. Revenue doesn't matter as much as compute capacity. Profitability is secondary to scale. Current losses are irrelevant compared to theoretical future dominance. This is the money timeline. Today, we're going to examine how AI valuations reach these extreme levels. We'll look at the economic structure that created this concentration of capital, why only a handful of companies can compete, and how the collaboration between tech giants is driving valuations higher while simultaneously increasing systemic risk. We'll examine OpenAI, Microsoft, Nvidia, Oracle, and Apple, and we'll explore how this could end very badly. To understand AI valuations in 2026, we need to go back to November 2022. That's when OpenAI released ChatGPT to the public. Before ChatGPT, AI was abstract. For most people and businesses, it was something happening in labs, not something you could use. ChatGPT crossed the visibility threshold. Within days, millions of people were using it to write emails, debug code, summarize documents, and explain concepts. The interface was simple. The results were immediately useful. This visibility created a psychological shift in markets. Investors suddenly understood that AI wasn't speculative future technology. It was deployable now. The comparison to the internet in the 1990s became common, but with a critical difference. The internet took years to demonstrate practical value. AI demonstrated value in weeks. This triggered a capital flood. Venture capital rushed to fund anything AI related. Public markets revalued tech companies based on their AI exposure. The fear of missing out wasn't just among retail investors. It was institutional. But the visibility also exposed a hard reality. Running these AI systems at scale is extraordinarily expensive. ChatGPT's success meant OpenAI was suddenly serving millions of users, each interaction costing money. Reports suggested OpenAI was spending over $700,000 per day just to run ChatGPT in early 2023. This created the central tension. The products work, people use them, but the unit economics are brutal. Scaling success means scaling costs faster than revenue. This should have tempered valuations. Instead, markets began pricing AI companies not on current economics, but on strategic positioning. Current losses don't matter. Market position matters. And market position requires massive spending to secure. By 2026, the AI market is measured in hundreds of billions of dollars. But unlike previous technology cycles where value spread across many companies, AI is concentrating in a very small number of players. This concentration is not accidental. It's structural. The concentration of AI value comes from what can be called the AI triangle, three elements that must work together: compute, models, and data. Compute means the hardware and infrastructure to train and run AI systems. Training a frontier AI model requires thousands of specialized chips running continuously for weeks or months. Running that model at scale for millions of users requires vast data center capacity. This is not cheap. Training GPT-4 reportedly cost over $100 million. Training the next generation will cost significantly more. Models are the AI systems themselves, the algorithms, architectures, and training techniques that turn raw compute and data into useful intelligence. Building frontier models requires world-class researchers, extensive experimentation, and iterative refinement. It's not just about having good ideas. It's about having the resources to test those ideas at scale. Data is the fuel. AI models learn from data. The more high-quality data you have access to, the better your models can become. But not all data is equal. Diverse, clean, relevant data is scarce. And as AI companies race to differentiate, access to proprietary or exclusive data becomes a competitive advantage. Here's the critical insight. These three elements only create value when they reinforce each other. Compute without models is just idle servers. Models without compute can't be trained or deployed. Data without both is inert. You need all three, at scale, simultaneously. This creates brutal economics. To compete in AI, you need billions in capital to secure compute, top-tier talent to build models, and access to massive datasets. Few companies can afford this. Even fewer can execute it successfully. The result is that value concentrates in companies that control all three corners of the triangle. This is fundamentally different from previous tech cycles. In the internet boom, thousands of companies could compete. Building a website was cheap. Distribution was democratized. In mobile, the barriers were higher but still accessible. But in AI, the barriers are extreme and rising. If you don't have tens of billions to spend, you can't compete at the frontier. This concentration has profound implications for valuation. In normal markets, competition drives down margins and valuations. But in AI, the lack of competition drives valuations up. Investors recognize that only a handful of companies can play this game. Those companies can charge premium prices because alternatives don't exist at the same quality level. The triangle also explains why partnerships and strategic investments dominate AI economics. No single company, except perhaps Microsoft, can afford to build all three corners alone. So we see intense collaboration. Microsoft invests in OpenAI to secure access to models. OpenAI partners with Microsoft to access compute. Nvidia supplies chips to everyone. Oracle builds data centers. These aren't arm's-length business relationships. They're strategic dependencies. This web of dependencies creates valuation feedback loops. When OpenAI's valuation rises, it implicitly raises the value of Microsoft's investment and Nvidia's revenue stream. When Nvidia's stock rises, it validates the spending of companies buying its chips. When Microsoft's Azure grows, it justifies OpenAI's compute costs. The entire system becomes interconnected in ways that amplify valuations across the board. But this interconnection also creates fragility. If one corner of the triangle breaks for any player, the entire structure is at risk, and there are multiple ways it could break. OpenAI sits at the center of AI valuation dynamics in 2026. Its $157 billion valuation in late 2024 was based almost entirely on expectations rather than financial results. Let's be clear about OpenAI's business model. It offers ChatGPT to consumers, some for free with ads, most on a $20 per month subscription. It licenses its models to enterprises through APIs, and it's increasingly embedding its technology into other products through partnerships. Revenue is growing rapidly, reportedly approaching $3.7 billion annually. But costs are also growing rapidly. Running ChatGPT for millions of users is expensive. Training new models is expensive. Paying world-class AI researchers competitive salaries is expensive. The company's compute bill alone runs into billions annually. Reports suggest OpenAI could lose up to $5 billion in 2024 despite growing revenue. In a normal business, this would be alarming. A company burning billions while generating billions in revenue is not obviously heading toward profitability. Unit economics matter. Margins matter. But OpenAI's valuation doesn't primarily rest on its current business. It rests on a narrative about the future. The narrative is this: AI will become a fundamental layer of the global economy. Just as cloud computing became essential infrastructure, AI will become essential intelligence. Whoever controls the best AI systems will extract enormous value. OpenAI, by being first to market with genuinely useful AI and continuing to push the frontier, is positioned to be that player. This narrative justifies the valuation if you believe AI models will become more efficient over time, that economies of scale will kick in, that enterprise customers will pay premium prices for reliable AI, and that consumer adoption will continue growing. It assumes OpenAI maintains its technical lead and successfully builds a moat around its technology. These are big assumptions. The counter-narrative is equally coherent. AI models are commoditizing rapidly. Open source alternatives are improving. Major tech companies are building competitive models. Running AI at scale may never become cheap enough to support high margins. Enterprise customers may resist lock-in to any single AI provider. OpenAI's response has been to scale aggressively. If margins are thin, make it up in volume. If competition is intensifying, spend more to stay ahead. This requires continuous capital infusions, hence the need to raise at extreme valuations. But this creates a trap. Each funding round, at a higher valuation, increases the expectations for exit. Eventually, OpenAI needs to go public or be acquired at a price that justifies these valuations. That price might not exist if the company can't prove it can generate profits at scale. The pressure this creates is enormous. OpenAI must simultaneously push the frontier of AI capabilities, scale its existing services, reduce costs, increase revenue, and maintain cultural coherence, all while operating under intense public scrutiny and facing competition from some of the most powerful companies in history. The valuation also affects behavior across the industry. If OpenAI is worth $157 billion, how much is a competitor with similar technology worth? This sets a floor for other AI companies. It encourages more capital to flood into the space. It pressures everyone to spend more, scale faster, and worry less about profitability today in pursuit of dominance tomorrow. But OpenAI cannot maintain this position alone. It needs partners. Specifically, it needs Microsoft. Microsoft's relationship with OpenAI is the most important partnership in AI. Microsoft has invested over $13 billion in OpenAI and provides the compute infrastructure OpenAI runs on through Azure. This partnership stabilizes OpenAI financially. OpenAI gets access to virtually unlimited compute capacity without building its own data centers. Microsoft gets exclusive access to OpenAI's technology, which it embeds across its product line. Azure, Office 365, GitHub, and Bing now feature AI capabilities powered by OpenAI models. For Microsoft, this is brilliant. AI becomes embedded in products customers already use rather than being sold standalone. Enterprise customers don't need to make a separate decision to adopt AI. It's just part of their existing Microsoft licenses. This allows Microsoft to monetize AI without proving AI is independently profitable. Consider GitHub Copilot. Microsoft charges developers $10 or $19 per month. Some reports suggest Microsoft loses money on each subscription due to compute costs. But Microsoft doesn't care. Copilot makes GitHub stickier. It increases the value of the entire developer ecosystem. Azure is the real financial engine. As companies adopt AI, they need cloud infrastructure to run it. Microsoft has positioned Azure as the go-to platform for AI workloads. This hides the true cost and profitability of AI. Is Azure growing because AI is profitable, or because companies are experimenting and will scale back later? The numbers don't separate these scenarios. Microsoft's valuation reflects this strategic positioning. Markets treat Microsoft's AI exposure as lower risk than pure-play AI companies because Microsoft has multiple revenue streams. If AI underperforms, Microsoft still has Office, Windows, and LinkedIn. But if AI succeeds massively, Microsoft captures enormous upside. This makes Microsoft the stabilizing force in AI valuation dynamics. However, Microsoft's heavy investment means significant capital is tied up in data centers, chips, and energy contracts. If AI demand growth slows, Microsoft faces underutilized capacity and declining returns on investment. Nvidia is the purest expression of AI valuation concentration. In 2026, it remains the primary supplier of specialized chips required for training and running advanced AI models. Its market capitalization has exploded, at times exceeding $3 trillion. This valuation rests on a simple fact. Training frontier AI models requires Nvidia's H100 and newer chips. Nvidia has roughly 90% market share in AI accelerators. Every major AI company is a customer. OpenAI, Microsoft, Google, Meta, Amazon, and Oracle are all buying Nvidia chips as fast as they can be produced. The financial results reflect this. Nvidia's data center revenue grew from roughly $15 billion in fiscal 2023 to over $47 billion in fiscal 2024. Gross margins often exceed 70%. The company is printing money because demand massively exceeds supply. But Nvidia's valuation isn't based on current revenue. It's based on the assumption that AI spending will continue growing exponentially for years. The problem is concentration. Nvidia's growth depends on a small number of hyperscale customers continuing to spend at extreme levels. If any slow spending, Nvidia's growth decelerates. Competition is also emerging. Google has TPUs, Amazon has Trainium, Microsoft is developing its own chips. None currently match Nvidia's performance, but the trajectory is clear. Nvidia's dominance will eventually erode. Nvidia's valuation prices in years of continued dominance. Any sign of weakening will trigger severe compression. The stock trades at a premium, even for a fast-growing tech company. So much future success is already reflected in the current price. Despite these risks, Nvidia's position in 2026 is extraordinarily strong. Every dollar spent on AI training flows through Nvidia's chips. This gives the company pricing power few businesses ever achieve. But the higher Nvidia's margins, the stronger the incentive for customers to find alternatives. Oracle represents the high-risk side of AI valuation. The company has poured tens of billions into building AI-oriented cloud infrastructure, betting that demand for AI compute will continue growing. The financial commitment is enormous. Data centers require massive upfront capital. Nvidia chips in bulk, energy contracts, cooling systems, networking. Once built, these costs are fixed. Revenue must scale to justify them. If AI demand grows as expected, Oracle's positioning pays off. If AI demand disappoints, Oracle faces a classic capex bubble scenario. Underutilized data centers. Depreciation and energy costs eating profits. Write-downs. Depressed returns. This pattern has played out before in tech. Telecom companies overbuilt fiber networks in the late 1990s. Many went bankrupt even though the fiber was useful. The issue isn't whether infrastructure is needed eventually. It's whether timing and scale match actual demand. Oracle's bet amplifies AI valuation dynamics. The company's willingness to invest tens of billions signals confidence that AI is real, but it also adds to systemic risk. If Oracle's bet fails, it signals that even with massive investment, AI infrastructure couldn't generate adequate returns. Other companies are making similar bets. Smaller cloud providers building AI data centers. Startups raising capital for inference infrastructure. Energy companies investing in power generation for AI. Each investment reinforces the narrative, but each also adds to potential stranded capital if growth slows. Apple's AI strategy stands apart. While Microsoft, Google, and others race to build massive AI infrastructure, Apple focuses on on-device intelligence. This limits both upside and downside exposure. Apple won't face massive write-downs if AI infrastructure spending proves excessive, but it could be disadvantaged if AI becomes the next platform-level technology. For now, Apple's conservative approach looks prudent. But if AI genuinely transforms computing, on-device intelligence may not be enough. The AI valuation structure in 2026 depends on very specific outcomes. The optimistic scenario requires AI to generate sustained high-margin revenue at scale, for unit economics to improve dramatically, and for all of this to happen fast enough to justify the capital already committed. There are multiple paths to a bad outcome. First, the profitability problem. If running AI at scale remains expensive and margins stay thin, AI becomes a low-margin commodity business. Valuations, assuming high-margin software economics, get crushed. Second, the stranded capital problem. Tens of billions have been spent on data centers, chips, and energy infrastructure based on projections of sustained high demand. If demand growth slows, this infrastructure becomes underutilized. You can't easily repurpose specialized AI chips. Companies face massive write-downs. Stock prices fall sharply. Third, the competition problem. If AI commoditizes faster than expected, pricing power evaporates. Companies can't charge premium prices if good enough alternatives exist for free or cheap. This compresses margins and forces down valuations across the board. Fourth, the macro problem. AI spending is driving capital expenditure and energy demand, adding to inflation. If central banks respond with tighter policy, high multiple tech stocks get hit hardest. Nvidia trading at 40 times earnings makes sense when rates are low. Much less sense when rates rise and growth slows. The systemic risk comes from concentration. Because so much capital is concentrated in a few interconnected companies, problems cascade quickly. If OpenAI faces stress, it affects Microsoft. If Nvidia's growth slows, it affects everyone buying chips. The feedback loops that drove valuations up could drive them down with equal force. The AI economy in 2026 is real and transforming technology, but it's also financially fragile in ways that echo previous bubbles. Only companies controlling compute, models, and data at scale can compete. This concentration drives extreme valuations as investors recognize winner-take-most dynamics. Strategic partnerships between OpenAI, Microsoft, Nvidia, and Oracle reinforce these valuations while creating interconnected risks. The valuations make sense if AI delivers sustained, high-margin growth at the pace markets expect. History suggests technology often delivers on its promise, but rarely on the timeline or financial terms initially priced in. The internet was transformative, but many dot-com valuations were disastrous. AI will likely follow a similar pattern. Transformative technology, real value creation, but a messy path from here to there. The concentration of AI investment in a handful of interconnected companies creates systemic risk. When everyone is betting on the same outcome, through the same players, using the same infrastructure, the downside scenarios become correlated. Thanks for watching The Money Timeline.